Most of our clients are looking for a tax deduction. And so on the tax deduction side, if you are a W-2 employee, meaning that you're not an independent contractor, you're not getting paid a 1099 that you can deduct your cell phone bill and your office expense and all that stuff against it. W-2 physicians, and I'm meeting with more and more of them that have very comfortably, the average is over $500,000 for a subspecialized physician on a W-2. You put that in California, you're looking at half your income is gone.
Mm-hmm.
You're begging for some relief on the tax side. So if a client comes to me and says, look, I really have a problem with taxes, we have tools in our toolbox with alternative investments to solve for that. And one tool in our toolbox is an oil and gas investment. And, you know, we talk about this and have looked at this for years now, but the word just hasn't gotten out yet. And I want to hear your thoughts on the oil and gas side of things and kind of the pros and cons, but just simply put, to start the conversation on oil and gas and W-2 employee mitigation of income. Simply put, an oil and gas investment has two features. One is the tax benefit, the other is the economic benefit. On the tax side, if you invest $100,000 in an oil and gas investment, typically you can reduce your gross income by something like $70,000 to $95,000 of that $100,000 investment in 2 years. Sometimes it's weighted heavier in the first year, sometimes it's weighted heavier in the second year.
So if I make $500,000 on a W-2, you're saying that I would only report about $420,000 of income, roughly, give or take.
Correct. So if a client comes to me and says, hey, I've got a $500,000 W-2 income, and they invest $100,000 into our natural gas partners, I tell them that they can reduce their gross income, meaning it's not a credit, it's actually a reduction of your gross income by something like $70,000, $80,000.
And what is that called?
So when a client says, wait a second, this is crazy. There's no way you can do this.
Yeah.
I had a client yesterday ask me, well, is that going to phase out because of the accelerated depreciation phase outs that have been happening since the 2017 legislation? I said, no. The reason we can reduce the gross income is because of an intangible drilling cost deduction. Now, I explain this to my clients as this has been around for multiple decades, and the purpose of it is to incentivize drilling. And that I reassure them that although 40 years ago they may have been drilling dry wells and speculative drilling and potentially wildcatting, that we're really not interested in that with the 4 companies that we have employed for our clients. Instead, we're looking at drilling programs that are not drilling dry wells, that are in proven areas. And I want to hear your thoughts on how you explain what a proven area is to clients. But to sort of zoom back out, when you invest $100,000, that is what I tell clients. If you make $500,000, you will be taxed as if you made $420,000, $430,000 in year one.
So $80,000 just disappeared. That's above the line tax deduction. And then you just apply your tax credit or your tax marginal bracket to that.
Right. I mean, it's as if you only made $420 or $430. It's not like a charitable deduction where it's like, no, it's as if you made $500, but it's like it's a credit against it. It's actually as if you never made it. So that reduces your marginal brackets and your effective tax brackets. The effective tax bracket being the combination or the weighted average of all of the marginal brackets, and then the marginal bracket being just whatever that top bracket is. You could potentially reduce your marginal bracket by that amount.